Welcome to Trial to Triumph, hosted by Caleb Johnson, the show about leaning into life's constant testing on your way to realizing your biggest blessings.
Welcome back, everyone. This is Caleb with From Trial to Triumph, and I'm very excited to be with you all today. And I have a very special guest, and her name is Bethany LaFlam. Bethany, how are you?
I'm doing great, thank you. How are you?
I'm doing fantastic. Thanks for asking. A little under the weather, but happy to be here. Very excited to be talking with you. So, Bethany, can you give our listeners just a quick background story about yourself and how you got into the space that you're in?
Yeah, absolutely. I grew up in Ohio in a pretty poor family, poor area, and I was told as an air quotes smart young girl that the way to get out of that was to either go to med school or law school. And those are the only two options that I knew of at the time. I didn't know entrepreneurship was even a thing then. And I was pre-med my first year of college, and I hated that, so law school it was. So I trucked out from Ohio to Southern California to Malibu to go to law school, and I never looked back since then. But I started off actually in litigation and quickly realized that was a little bit too combative for me, so I realized that I really like working with entrepreneurs and business owners and switched fairly quickly over to the transaction side. I've been doing securities law for over 20 years now, and then specifically in the real estate space for about 7 years now. So that kind of led me all through here, all to avoid staying in Ohio and in poverty.
Wow. Well, I know you've done very well for yourself. So are you glad you kind of got out of Ohio?
I am. Ohio is a wonderful place to be from, is what I always say.
That's funny. Yeah, I've heard some places they call it the mistake by the lake. I won't get too deep into that because we might have some Ohio listeners. But yeah, so I know you focus on syndications as especially, and I'm in that space. And so just for the listeners, a syndication is if I'm going to go buy a property, let's say a 100-unit apartment complex, in my plan, I don't have the $10 million to buy it. So I'm going to raise capital from investors, bring them together in what's called a syndication, and provide an offering an investment return to the investors that do participate in that investment. And we need some documentation, and that's where you come in, Bethany. Is that fair? Or
Yeah, for the most part, yes. So whenever there is a security being sold, so you've got a passive investor looking for a return based on your efforts, then you've sold a security, and you need to make sure that you are exempt with SEC rules. Exempt from registration or in compliance with SEC rules. And so, yes, there's documentation, and then there's a little bit more to it than that, where I come in to make sure everything you say to potential investors and actual investors is compliant with securities rules.
If someone, let's say, wanted to explore actually registering with the SEC, how long does that process usually take? And so why is it then advantageous to just use an exemption?
So if you're going to register a security, usually that's going to be like an IPO, an initial public offering like Microsoft or Facebook. That could take years, at least several months, and it can cost hundreds of thousands and more in order to do that. And that doesn't work for the average real estate investor because you've usually got like a 30 to 45 day close window.
Right.
And we're talking about, maybe up to a $10 million raise. Most of our clients are really between the $2 and $15 million. It doesn't necessarily make sense to do a public offering for that. There is another registration that you could do, which is a Reg A, and then sort of a mini IPO between Reg A and a Reg CF. But most of our clients are under an exemption from all of the registration, which is a Reg D. So a lot of your investors, if they've even heard of syndications at all, have probably heard about Reg D, 506B, or 506C. That is where 95% of my clients live.
Mm-hmm. And can you just give a quick background about what 506B and 506C are and the differences?
Sure. 506B is the exemption where you can accept up to 35 non-accredited investors. So non-accredited means they do not have a net worth of $1 million or more, excluding their primary residence, or an income of $200,000 or more for the past 2 years, and reasonably expected again this year, or 300,000 if they want to count their spouse as income. There are a couple other ways to be considered accredited. That's less typical. So those are the two main ways people are accredited. So you can have in a 506B, you can have up to 35 who are non-accredited, but they have to be sophisticated. They still have to know what it is they're getting into. But the trade-off there for being able to accept non-accredited investors is that you cannot generally solicit or advertise. So no Facebook posts, no email blasts, no billboards on the side of the freeway, no TV commercials or ads. It means you need to really have a substantial pre-existing relationship with all of your investors that you're speaking to, even if they are accredited. So that's 506B exemption. 506C exemption is where you can accept only accredited investors, so people above the income or the net worth threshold, and you have to take reasonable steps to verify that they are in fact accredited before you can take their money. But the trade-off there is that you can advertise and generally solicit. You can shout it from the rooftops. You can pick people up at a bar to invest. You can meet them at a networking event. You can whatever it is you want to do within reason. Of course, there are still rules. There's the anti-fraud provisions. So everything you say needs to be true and not misleading without further context, even if you are advertising. So that's 506C.
Okay, that helps a ton. And is it possible, let's say if I present my offering to my investor database and I start with a 506B, and then partway through I realize, I'm not going to make the deadline, and if I can advertise, then I might be able to meet the deadline and raise the capital I need to close. So is it possible to go from one to the other, or vice versa?
That's a great question. And yes, that's one of my favorite things to do, especially with first-time syndicators, is we can structure it up front where you start off with a 506B, you get everybody you know really well in, all your non-accrediteds come in, and then you can, as long as you give all the proper disclosures, which of course I can help you do, then you can shut that off, you stop it, you end that raise effectively, and then you can go to market and start to advertise the next day. But at that point, you cannot take any further non-accredited investors' money. So even if they've committed, I wouldn't even take their money after that date, because the minute you advertise, 506B is no longer an option, which means you can't go the other direction. You have to start with a B and then go to a C.
Okay. Now what are some things that you see investors get in hot water in? Let's say if they're planning to do a 506B, right? Just my pre-existing relationships. That's all who I'm going to raise capital from. And I know there are some things that could even be, let's say, prepping the market or testing it, even though I'm not offering a public opportunity, but I can still maybe present myself in a way that could come back to hurt me if I'm just doing a 506B offering. And so what are some things that people say that could lead to getting them into hot water?
So you alluded to one of them, which is called conditioning the market. That even though you're not actively telling people, hey, invest in my deal, I have this deal, and I'm advertising that I'm going to allow it in. If you are all of a sudden loud on social media when you've been quiet prior to having a deal, and it looks like you're trying to drum up investor excitement by your posts, that could be what the SEC considers conditioning the market, which is not allowed. Because you have to remember that 506B, the SEC cares about both the offer and the sale of securities, right? So it's not just at the point when they give you money and buy. They want to know how you're getting them in the door to advertise to them or to get them interested in investing. And so if you're conditioning the market, it looks like you're kind of trying to bypass the no solicitation rule by getting people excited by posting on social media. So that's one of the big ones that I see. And kind of ancillary to that, although maybe even a little more common, is a lot of first-time investors, or first-time syndicators rather, they need to co-sponsor deals. They need to have partners to come in to the deal with them. One of the big things I see is these sponsor teams not communicating and doing diligence on each other before they get started, and they just kind of jump in together and everybody just gets started, and they're not on the same page about how they're going to run this deal. The reason that's important, well, one is you need to be aligned in your values and your goals before you get into any kind of partnership. But the reason why that comes into play early on is, and I've seen this happen with investors, is let's say one group of people is like, yeah, we're going to have to advertise out of the gate. And the other group is saying, well, I kind of want my friends and family to invest, and they're not yet accredited. So they think they're going to sell it to mom and dad and their uncle, and the rest of their team is already off on social media, which means now 506B is simply not an option now. There's nothing you can do about it. It's just not an option. So by not communicating ahead of time and making sure everybody's on the same page, they've already blown one of their exemptions, right, by advertising ahead of time when maybe that's not what everybody intended to do. So there are a lot of reasons why you should do diligence on your partners. That's one. Of course, the other is you want to make sure that your values align. What's your risk tolerance? Who are your intended investors? How do you want to run this deal? Who's doing what thing? Which then leads into the other big mistake I see early syndicators doing, which is trying to pay people just to raise capital who are not broker dealers. I have this conversation every single day, sometimes with the same person every single day. I can't tell you. I know it's not a fun answer to give, but you are definitely not allowed to pay people just to raise capital for you. And I will tell you that every one of your listeners, Caleb, every one of them has been approached by somebody offering them a piece of GP to raise money for them. I almost can guarantee it. It's still illegal. Just because everybody's doing it doesn't mean it's okay.
Right.
I have this conversation with experienced syndicators and with brand new syndicators because I get it. Raising money is super important. That's what you have to do it to get these deals done. And I realize that it's sometimes harder than people think when they get started. But in order to pay what we call transactions-based compensation, the person has to be a registered broker-dealer. So not a real estate broker, but a FINRA registered broker-dealer in order to get a fee to raise capital. So I'm not here just going to tell you what you can't do. I can tell you, though, how you can compensate people fairly. One is give them a job and bring them in as a co-sponsor, right? And just make sure that whatever other job they're doing, whatever they're getting paid for that job, just should make sense for that job. So if I say, look, I can probably raise $2 million towards your deal, that's fine, but my comp can't be related to that $2 million, and it can't fluctuate up or down whether or not I raise it. But what I also should be doing, especially if I'm raising money, I should probably be doing some diligence. Maybe I'm doing underwriting, maybe I'm boots on the ground. Whatever it is, if I'm responsibly raising money for a deal, it really needs to legitimately be part of my deal, or partly my deal. But also, I should know what I'm getting into and what I'm getting my investors into. So it's a wider lane if you're an investor relations or capital raising. It's a wider lane than a lot of people think. But what I get paid needs to be based on the other jobs I'm doing besides raising capital. The other way you can get paid if you want to bring money into deals is to start a fund of funds. That's actually becoming way more popular these days. It's a fair amount of work. You are managing a whole fund, so you're not just capital raising, you're managing a whole fund. But the benefit there is you get paid at the fund of funds level, so you have some negotiating power with the people you're raising capital for. You can say, hey, listen, your minimum is $50,000, I'm going to bring you $500,000. I would like a better return, please. Well, now you've got some meat on the bone that you can make a fee legally, right? And the other reason that that's becoming more and more popular is your investors in a fund of funds, they stay private. They stay your investors. Whereas if you're raising into a deal, they become investors of the whole project. Everybody gets to see them. Everybody gets to know. And if you haven't done that first thing I said, which is diligence on your partners, you don't know if your partners are going to go to those people and solicit them for deals that you're not in. So a fund of funds would shield all that. So now you're the main point of contact to the syndicator that you're raising capital for, and you can shield your investors from that. So a fund of funds is a great way that people are really bringing capital into good syndicators deals. You still have to do diligence, you still have to pick good deals, but it's a way for you to get paid and not have to actually operate the underlying property.
That sounds like a much better option, just to go the fund of fund route compared to the syndication, especially if you want to preserve your investors and that relationship you have with them. And Bethany, from my understanding, what a fund of fund is if I'm going to start an LLC, essentially, ABC LLC, and I'm going to have a bank account with that entity name, and then pull my investors, and I'm going to, essentially, I have my own offering that is going to invest in another, let's say, real estate apartment building. And so my LLC is essentially the one that's sending the wire transfer. Now, all my investors, they're going to send their wires into my bank account, and then from there, since it's a whole different opportunity compared to the actual property that we're buying, that way I can structure the fees differently, right? I can essentially fee my investors any way that I want, as long as if they invest in the deal and they feel that that's fair, then that's fair game. Is that kind of fair, or am I missing something?
No, that's pretty much it. Great job. It just means that you're creating your own fund, and the fund's purpose is to be a passive investor in other people's deals. And so you're exactly right. People are going to invest in your deal. So you actually are doing your own. It is still a syndication. You're doing your own offering to your investors. So you've still got to comply with securities laws. And then there's one more layer of compliance that you need to contend with, which is you're acting like an investment advisor. So you need to make sure that you're exempt from having to register as an investment advisor. And that varies depending on the state that you're in. But for the most part, it is a way, you're right, you can charge whatever fees you want. You are going to have to do some work for that to justify it. But if you disclose it to your investors and they agree, then you can, even if they end up getting a lower return from your fund than they would have gotten had they gone directly into another syndication, you can make the argument, okay, but I did the diligence for you. I got I got you into a deal you might not have been able to get in on your own because their minimums are higher than what you were putting in, or you can get diversification across multiple operators. There are a lot of ways you can add value to justify those fees.
Mm-hmm. Right. And now, Bethany, if I am, let's say I have a real estate opportunity, I'm closing, I'm the operator, and it's a 506B. Now, let's say someone else, let's say Randy, wants to invest in my opportunity, and has a fund-to-fund, but his fund-to-fund is a 506C. So he's advertising, hey, invest in my fund. He's not maybe referencing my property, or maybe he is. And so since mine is a 506B and he's advertising as a 506C, does that cause some conflict?
It could. What I would say is to have him not advertise your deal, meaning he can advertise his fund to funds. And I know a lot of fund to funds operators will say, yeah, but I'm actually going to just use the underlying PPM and I'm gonna pitch the underlying deal. If that's the case, now you do have a conflict. But if they have what we call a blind pool fund to funds, right, where they're telling investors, hey, trust me, and here's the criteria of how I'm gonna pick operators, and then I'm just gonna go pick them, then it's a blind pool, no problem. But if he's saying, hey, I'm gonna invest specifically in this deal, and now he's advertising for you, now that could be a problem. Same is true vice versa, the other way around. If you have a 506C, they can't then go bring non-accredited investors into your deal, right, unless they're accredited. So all of the investors in their deal would have to arguably be accredited because there's a look-through, unless their fund is actually worth already $5 million, not raised for the purpose of investing in your deal.
Right. Okay. Now, let's say someone does something they shouldn't do, right? Let's say we've been telling them, hey, don't do this, don't raise capital, and that's your only job, have other roles. But let's say someone, it's a 506B offering, and someone advertises, right? My deal is a 506B offering. I partner with Randy again, but Randy advertises, right? Or he doesn't have a pre-existing relationship with somebody. He shares the opportunity with an investor, and that investor ends up investing in my deal. I don't know, right? I don't track exactly what Randy's doing with his investors, his advertising exactly. He just brings an investor in, and we close the deal. Now, let's say a year goes past and the investor hasn't received the distributions like they thought they would, or something unforeseen happened with the opportunity, and they're upset. And now they come to me and our team, and they're suing the team. Am I liable for that? And if I am, what kind of happens after that?
You could be. So sponsors are together. This is why I say due diligence on your partners to make sure everybody's aligned in their risk tolerance, because you all form a management company together. It's an LLC usually. You're all members of that LLC. So if anybody's going to get sued, it's going to be that LLC, right? So if the LLC then has any liability, all of the managers and potentially the members could have that same level of liability. Now you do have the protection of the LLC, so that you shouldn't personally be on the hook unless you personally did something to defraud somebody, right? So that's why we do that in an LLC. However, it could derail the whole entire deal. And by that I mean you're part of the sponsorship team. If that investor gets his or her way, they could get a judgment, and a couple things could happen. One is you could have to get rid of all the non-accredited investors and give them their money back, because now it really should have been a 506c because you advertised. And you're going to have to go verify all the investors. Now, you already didn't comply because you're supposed to verify before you take the money. But you can go back and at least try to fix it, when I would say stop the bleeding, so that if the SEC does come knocking, you at least have been like, we found the error, we fixed it. Likely for that, there might be a penalty, there might be a fee, you might have to give some people's money back, but you're not going to go to jail for that, right? So that's the way you could be on the hook. The other thing that the SEC could do is say, now this whole deal, you've got to get everybody their money back, and now you've got to come up with a way to get their money back. Maybe sell the property before you're ready, or and it could even go as far as to say, hey, we're going to make an example of you. You guys are out of this game. You can't raise money anymore from people because you violated securities laws. Is that likely to happen? Maybe not that far if you catch it and you try to make it right. But what you have to remember is that if the SEC gets involved, you've got a human being that's an investigator right now. And you don't know, they've got some guidelines that they're going to look at, but you don't know if you're getting that person who's trying to make their whole career to make an example out of you. Or if that person who's just like, all right, it looks like you guys are trying to do the right thing. This guy went rogue. Just fix this and don't do it again, okay? You could get that, or you could get the guy that's like, now you're all going to jail, right? Now, you're not going to probably go to jail for that. I mean, even no matter what a bad mood somebody's in, you're probably not going to go to jail unless you meant to defraud people. But again, you just got to be ready for, somebody who's going to push it as far as they can on the SEC side. And so what we always tell people is, I'm going to give you best practices. I'm going to set up some guardrails for you, and I'm going to need you to stay within those guardrails. You're grown people, so you're going to decide how close to the wall you want to get, or if you decide it's not, you're not really that scared of going a little bit outside the wall. You can decide what level of risk you're willing to live with. Just know it's risk.
That's great. Yeah. And it's definitely scary stuff. If people are getting into the space and they've never invested in a syndication before, or an apartment complex, and they're hearing terms like go to jail, and if my partner does something that I can't even really control, then I might be liable, and it might be sounding very scary. But I think I love what you said earlier. It goes back to doing the due diligence on the partnership team, right? That's why you don't just get in bed with someone after you just hear from them, right? After the first phone call, you actually get to know someone over 3, 6 months, 12 months even, see some deals that they're working on, and it's a patient game. It's challenging for sure. And if someone refers somebody to you, like a best friend or another operator that like and trust, refers someone else to you and says, hey, Peter has this opportunity, go ahead and I know you have some capital or some investors that want to invest. Of course, you need another role, right? It just can't be for capital purposes, but go ahead and invest in Peter, and I trust him, I've worked with him. And so it can be very challenging, kind of daunting getting into the space, but I think it helps to have people in their corner, right? A syndication attorney, real estate attorney, to guide those investors that are newer.
I agree. And what I always tell people is rely on, I always say OPE, right? Rely on your other people's everything. Figure out what you're amazing at and what you love to do, both. Amazing at and love to do. And literally for everything else, there's another person who's an expert at it, and they love to do it, and they're amazing at it, even if you're not. And it's sometimes even hard to believe. Like for me, I'm like, underwriting, no thank you. There are people that just love to do that, but would never want to do what I do. So, there are people that are really good at it. Just surround yourself with people who've done that. It's not as scary. My clients aren't scared. They know I've got their back. They know we've got it covered. And as long as they listen to the advice we give them, then they're gonna stay out of trouble. It can be scary. That's true. But you've got to do your diligence. I mean, just like you wouldn't go buy an apartment complex without walking it and checking out the numbers and whatever, right? You shouldn't get into a 5 to 7 year relationship with someone without knowing who that is. even if they promise you that they can bring you millions of dollars.
Especially if they promise you that.
Exactly, especially then.
Now, let's, I kind of alluded to it earlier, but are there other, if I want to buy an apartment complex, are you my go-to, like, or are there other real estate attorneys, people that will help with other parts of the process, or are you really a one-stop shop?
We are just on the securities compliance side. We are talking to actually some groups about the real estate transaction side, but I'll tell you, I've got some referrals that we'd like to work with on the real estate transactions. But if you need help with your purchase and sale agreement, dealing with your lender, getting through to the closing table, that's a real estate transactions attorney, and I can always provide a referral. But or PLG is your place to go for SEC compliance, all the things. We help you practice safe SEC.
Perfect. And what does PLG stand for?
Premier Law Group.
Okay, perfect. And so just from my understanding, just for clarity's sake here, so if I'm doing a syndication, then I'm going to Bethany. And so you can help me with the PPMs, other documentation whenever it pertains to the syndication specifically. And if I'm still doing a syndication, I'm going to work with you, Bethany. And at the same time, I'm going to have a real estate attorney specifically that will verify my PSA, my purchase and sale agreement. They'll work with the lender, they'll work in between the seller, and they'll really make sure all the I's are dotted, T's are crossed on that front. Is that right?
Exactly. That's exactly
Perfect.
right.
Awesome. And now, Bethany, if again I'm putting together a syndication, at what point should I contact you? Is this something where you and I should have a relationship? You should know my company before I even start looking at deals? Or is this something where once I have a PSA signed, once I have done the due diligence, that's when I first contact you and we work together from there?
I do like to get to know people as they're building up their business, just so I can help them know what they're doing as they get into it. But not everybody's in a position to do that, or doesn't even know yet. But at least at the point when you have an LOI accepted is when you should reach out. And the reason for that is you want to give yourself enough time to do all the compliance work so that you're not chasing a closing, and you've got time to raise the money and time to do it legally. So the time you get an LOI signed, even before, you don't want to get all the way through diligence. You're not going to leave yourself enough time to raise the money. And for this reason, this is why both my partner Mauricio Raul and I, we both do free lives for people who are getting ready to syndicate. And you can get all the education that you need. You can ask questions as you're leading up to it. We do have a Kickstarter package if you're not looking at deals yet, but you still want to get started. We have tools for early syndicators to learn what they're doing without breaking the bank. You don't want to pay $15,000 until you have a deal. Mm-hmm. I understand that. We understand that. So I do a free live every Wednesday at 1 Pacific. I can give you that link, but it's bethanylaflam.com/live. My partner does one on Mondays. I think it's 11:30 Pacific. Today he already did one. That's mauricioraul.com/live. So we give you all of the education that you need so that when you are ready to sign that LOI, you're ready and you know what you're supposed to do.
That's very helpful. I actually didn't know that, so that's incredible. And is that something where if someone joins, they can ask questions live, or do you more like have a presentation you're going through?
No, mine is a straight up Q&A that I do. Mauricio sometimes has a topic and then there's Q&A. Mm-hmm. And so if it's a topic that you're interested in, you can go listen, and then at the end is Q&A. But mine's an hour of Q&A. I try to reserve the last 30 minutes just for funds and fund to funds questions because there's so many of them. Mm-hmm. But it's whatever questions you might have, and I get a lot of questions on how do I structure my LLCs, or what can I say on my website, those kinds of things as people are getting started. And we go over it every week, and you can ask questions. And it's not a huge group, so most people get their questions answered within that hour.
Oh, that's great. That's very great. Now, how much, again, you might have preluded to it a second ago, but how much time do I need? Let's say my real estate attorney is looking at, they've completed the purchase and sale agreement. We're about to sign on the dotted line. And is that when I call Bethany up or I email you and I say, hey, Bethany, this is the purchase and sale agreement we're working with. This is our attorney. And just want to give you a heads up, we'll probably start needing some PPMs and going down that route. Should I contact you at that point or more after we're about done with DD, 15 days after PSA is signed, or is it right once the PSA is signed?
I would do it even before the PSA is signed. When you've got an accepted LOI, you can give us a call so we can at least help you get the ball rolling. You want to get your entities going, your LLCs going. We want to start talking about what your business plan is, and we just want to talk about some rules of the road before anybody starts advertising or anything like that. So we want to talk about your goals. One of the first things we do is we talk about what's your goal for the deal. So the earlier the better.
Mm-hmm. Fantastic. And you mentioned earlier how should I structure LLCs with a syndication? I know this can be kind of challenging to want to explain without a whiteboard. But how would you explain structuring LLCs if I'm just doing a basic syndication, not a fund-to-fund structure, but just a syndication?
So for a basic syndication, and I'll give you the high-level basic syndication, and then also know that our engagements come with a 30-minute consultation with an asset protection attorney. So if you have more things to consider, you can talk to them. But the high-level basics is you're going to start with a management LLC. So that management LLC is going to make all the decisions for your syndication. That's going to be you as the sponsor, whoever your partners are making the decisions for the syndication. That LLC is going to be formed in where the decisions are being made, so where you live. Right? If people live in multiple places, we'll figure that out, but it's where you live. That LLC is going to make decisions, and it's going to be a non-member manager, meaning it's not going to own any of the units. It will own nothing. It may get fees, acquisition fee, asset management fee, whatever. It may get fees, but it owns nothing. Then we create a syndication LLC, and that sits in the state where the property is. So that's an LLC, and that syndication LLC owns the property. That's your borrower, right? And it's owned by Class A members are your limiteds or your passive investors. Those are your investors. And Class B members are you again as the sponsor team, not through the manager, but through holding companies. So usually a Wyoming holding company that just owns your units there. Doesn't make any decisions, doesn't do any business, just safely holds your assets. So that's the high level structure of a syndication. And we can actually share with you the drawing so you can actually give it out to your listeners.
Oh, that'd be fantastic. That'd be really great. And just for clarity's sake again, Bethany, that was first a really great explanation. And from my understanding then, you'll have one LLC that's, let's say if I'm in Arizona, it's going to be an Arizona LLC, and that's managing the property, right? Asset managing the property. Mm-hmm. And I will receive my fees that are structured in the deal through that entity. Acquisition fees, asset manager fees, capitalization, transaction fees, things like that. And that's important that the fees receive that because otherwise it's taxed differently compared to equity and cash flow. Mm-hmm. And then the second LLC, that is holding title of the property. That's where all the investors will ultimately invest, the passive investors, and that's where me and the other general partners will actually own our equity stake in the property as well. And so then all cash flow and equity will be sent through that LLC to all of the members that own shares in that. Is that fair?
That's exactly right. Great job.
Perfect. I've been studying that, and you've done a good job of explaining that, so I learned it from you. So, and I know, Bethany, we'll start wrapping up here, but with one more question, what are some other ways, that syndicators don't think about where they can get in trouble? I know we kind of talked about what people say, but are there other things where syndicators that are getting started in this business, they don't think about, but it can actually lead to getting them in hot water? Is there anything like that?
Yeah, I mean, the absolute biggest one is choosing a sponsor team and then not being able to get the raise done and then just bring people in last minute just to raise capital. That is what I see the most. And that could get you into some hot water because then it looks like you're paying people just to raise capital because at that point you probably are. So really, again, it boils down to doing diligence on the team and really understanding what the capabilities are from everybody on your team to make sure that everybody on that team can get it done in the way you plan to get it done. So it all really boils down to diligence on your team.
I love that. Well, Bethany, we'll start wrapping up here, and I ask every guest the same 3 questions. And the first question I'll ask you is, if you can recommend a book to our listeners, what would that be?
So, as I mentioned to you earlier, I'm writing a book called The Power of OPE, Other People's Everything, but that's not out yet. So the one book I think that was life-changing for me was Who Not How. Dan Sullivan, Who Not How. Although I'm currently reading Buy Back Your Time, and that it's a very similar concept. Basically, it is, you shouldn't be doing stuff that you shouldn't be doing. Entrepreneurs fall into this trap of trying to do everything, and it is gonna burn you out, but also not the best way to be safe or to make a lot of money. So Who Not How is my recommendation.
And Bethany, if people want to learn more about you and work with you, get in touch with you, where's the best place they can do that at?
They can find a lot of videos and education on my Instagram page, which is Bethany_LaFlam, or on my YouTube channel, which is Bethany LaFlam. And you can always reach out to my team at team@plglp.com.
Perfect. And lastly, Bethany, if you can share one final thing with our listeners that they can take away from today's show, what would that be?
As you're starting out, you're going to learn all the things that need to be done on a deal. But you're going to also quickly learn the things that you are in love with doing and the things you hate doing and the things that you suck at doing and the things that you're good at doing. Stay in the things that you love and the things that you're good at, and literally partner for everything else. I know I already said this, but it is the biggest piece of advice, because as entrepreneurs, again, we tend to feel like we have to do everything ourselves, and especially as we're getting started and we think we don't have enough money or anything like that. Find partners that love to do the things that you hate to do and that are good at the things that you suck at, and then stay in your lane and find someone that's good at the other things. And that's going to help you, 1, be a lot happier, 2, make a lot more money, but 3, be a lot safer, legally speaking, because you're not dabbling in things that you're not that good at. So I would say choose your lane and then stay in it.
Well, Bethany, that was very profound, and I love that. And thank you so much for being on the show. All this information is so, it can feel like it's so out there, like people don't know what they don't know, and you've just put it in a very concise, digestible way for me, and I know for our listeners. So really appreciate your time for being here.
Oh, it's my pleasure. And I definitely recommend everybody reach out to the free lives. You do not have to be a client to be on those lives. There's no pressure to be a client. I just want the community to be educated.
Perfect. And everyone for tuning in. Catch you next time. Bye.
It's time to grab your victory. Find us on the web at redseacapitalgroup.com and follow us on Instagram and Facebook at Red Sea Capital Group.